Good day, and welcome to the Sterling Bancorp Q4 2019 conference call. Today's conference is being recorded. At this time, I would like to turn the conference over to Jack Kopnisky. Please go ahead.
Good morning, everyone, and thanks for joining us to present and discuss our results for the fourth quarter and fiscal year 2019. Joining me on the call is Luis Massiani, our Chief Financial Officer, and Emlyn Harmon, our newly appointed Director of Investor Relations. We have a presentation on our website, which along with our press release provides detailed information on our quarterly and year-end results. During the call, we will highlight our strong quarterly and year-end financial metrics resulting from strong targeted commercial loan growth, diversified deposit growth, solid fee income, continued strong credit quality, superior levels of capital, and significant cost controls. In the fourth quarter, we were able to execute several strategic actions that will continue to remix the balance sheet to enable the company to produce increased earnings and positive operating leverage in 2020 and beyond. During the quarter, we acquired a targeted $839 million equipment finance portfolio, issued $275 million of sub-debt at favorable rates, continued to reposition our balance sheet and earning asset mix, and repurchased 4 million shares of stock. On an operating basis, our fourth quarter results were strong. Adjusted net income available to common shareholders for this quarter was $109 million, a 3% increase over the linked quarter. Adjusted earnings per share of 54 cents was 2 cents or 4% higher than the linked quarter and the fourth quarter of 2018. Adjusted return on average tangible assets was 151 basis points, and adjusted return on average tangible common equity was 16.6%. Our efficiency ratio continues to be among the industry leaders at 40%. Our tangible book value per share of $13.09 increased 1.5% over the linked quarter and 11.1% over December 2018. The EPS of 54 cents and tangible book value of $13.09 were record levels for our company. During the quarter, we continued to remix the loan and securities portfolios to achieve higher risk-adjusted returns. Total assets increased by $500 million during the quarter as we are now in a position to grow the overall balance sheet, given that most of the balance sheet repositioning is behind us. We continue to produce strong loan growth. For the quarter, inclusive of the equipment finance portfolio acquisition, commercial loans grew $791 million, or 4.4% over the linked quarter. On an annual basis, targeted commercial loans grew $2.8 billion, or 17.2%. During 2019, we reduced low-yielding residential and consumer loans by $566 million, resulting in total growth in portfolio loans of $2.2 billion, or 11.6%. Commercial real estate, public finance, mortgage warehouse, and lender finance portfolios have all grown organically by more than 10% year over year. We had a strong quarter for deposit growth. Total deposits increased by $839 million on a spot basis at year-end. Average deposit balances increased by $1.5 billion over the linked quarter. As the seasonal municipal balances declined in the quarter, we were able to replace and grow core commercial and consumer balances, direct bank, and broker deposits at more favorable rates. Deposit costs declined by 3 basis points from September 30th, 2019, and overall weighted average funding costs declined by 10 basis points. We're focusing on reducing deposit costs in the targeted high-cost municipal relationships and a $1.2 billion consumer CD portfolio that will reprice by March 31st, 2019. We expect to lower deposit costs by 5 to 10 basis points in the first quarter of 2020. Our mix of products, channels, and funding sources provide flexibility to grow balances while we lower funding costs. Our core net interest margin, excluding accretion income on acquired loans, was 313 basis points for the quarter. The declining interest rate environment has resulted in lower asset yields on our floating rate loans and securities that comprise approximately one-third of our assets. Coupled with competition for deposits, our net interest margin has been pressured, but we have been able to maintain a stable core net interest margin over the past 18 months as a result of our remixing of earning assets and our focus on controlling deposit costs. Assuming no changes in the rate outlook, we anticipate that our core net interest margin will remain in a 315 to 325 basis point range into 2020. Just a note on the core interest margin, we held significant cash balances in the quarter to purchase the equipment finance portfolio. If these cash balances would have been invested, the margin would have been approximately 317 basis points. Core fee income growth continued to be solid as a result of commercial loan fee income, swap fees, treasury management fees, and portfolio fee improvements. Adjusted fee income was $117 million and grew by $15 million or 15% over the full year 2018. Core expenses, exclusive of amortization of intangibles, increased modestly from the year ago quarter to $105.5 million, or up 1%. We continue to aggressively reduce our financial center network and staffing and have reallocated a portion of the reductions to support growth in the commercial teams, technology, and enterprise risk management. In 2019, we consolidated 24 financial centers, resulting in 82 financial centers at year-end. We expect to be under 80 financial centers in 2020. Overall, our expense run rate for the quarter equates to an annualized operating expense level of $419 million. As we indicated in our earnings presentation, we expect operating expenses will be in the $420 million to $430 million range for 2020. Credit quality and capital levels remain strong. Charge-offs decreased by $5 million over the linked quarter as we dispositioned previously identified equipment loans on an annualized basis. The $9.1 million of charge-offs represents 17 basis points of loans. The levels of non-performing loans and delinquency levels improved this quarter. Substandard loan categories increased, but these increases represent secured, performing, and appropriately marked loans. Given a stable economy, the low rate environment, regulatory oversight, and the mix of our portfolio, we expect to continue to see strong credit quality in 2020. Total tangible common equity to tangible assets was strong at 9%, and total risk-based capital at the bank was 13.6%. During the quarter, we repurchased 4 million shares and have 1.6 million shares remaining in our repurchase authorization. We continue to evaluate the use of excess capital for investment into our core business, share repurchases, and dividend payouts. We were able to execute a favorable $275 million debt issuance in the quarter that will refinance existing debt due in mid-2020 from the Astoria transaction and provide growth capital for our company. One of the core fundamental elements of our culture is our focus on constantly reinventing our company. We believe that great companies constantly change, adjust, and improve to meet the demands of our shareholders, clients, and colleagues. Our objective has always been to position the company to be a high-performance organization regardless of changes in the economy, rates, or the competition. The majority of questions we receive from investors relate to the dynamics of growth in later cycle, lower rate environments. I would like to highlight some of the steps we have taken across a number of areas to position us for continued steady growth. While producing record tangible book value and EPS over the past year, we have also successfully remixed the asset side of the balance sheet by exiting non-relationship, low-yielding residential and multifamily asset classes and replacing them with targeted relationship-oriented, higher-yielding CRE and C&I loans. We have made this transition by organic originations through our 35 commercial relationship teams and by acquiring targeted high-quality loan portfolios. We originated a record $1.6 billion in commercial loans organically this year and acquired two portfolios totaling $1.2 billion for total commercial loan growth of $2.8 billion in 2019. We have the ability to continue to grow the commercial side of the company and related revenues now that the majority of this transition is complete. The combination of these efforts and steps we have taken to manage our liabilities have successfully repositioned our balance sheet to maintain a steady year-over-year core net interest margin despite 75 basis points of Fed funds reductions, a flatter yield curve, and a competitive environment for deposits. We have developed multiple funding sources that have distinct volume, cost, rate, and term attributes. The financial centers, commercial teams, digital, and wholesale channels enable us to have options in how we fund growth. The fourth quarter provided a good illustration of this capability as we grew our overall deposits by $839 million despite nearly $250 million in seasonal municipal runoff, while also lowering our cost of deposits by 3 basis points. We will continue to refine existing channels and seek new funding channels. Our credit quality has remained exceptionally strong. For the past 8 years, we have focused significant resources on creating a best-in-class risk management program. Over the past year, we have enhanced our credit group by acquiring significant talent and technology to support growth and deal with future credit cycles. Overall, our CRE portfolio has a loan-to-value of less than 48% and a debt service coverage of 1.68 times. Our C&I portfolio is 97% secured within margin by accounts receivable, inventory, or equipment. We believe credit quality will be strong for the near future given a stable economy, low rate environment, and tightened regulatory standards across the industry. We are confident in our model and our ability to meet and exceed our growth and return targets in the future, even in a lower rate environment. The past year was challenging due to the rate changes and the flatness of the yield curve. We successfully repositioned the company to deliver in 2020 and beyond positive operating leverage and strong earnings per share growth, return on average tangible assets of 150 basis points or greater, return on average tangible common equity of 16% or greater, efficiency ratios of less than 40%, and growth in tangible book value of greater than 10%. We continue to point to the information on page 4 of the presentation that reflects the overall results of our actions over the past several years. Over the past 5-year period ending December 31st, 2019, our adjusted earnings per share growth compounded at an annual growth rate of 21%, and our tangible book value per common share has grown at 15%. Thanks, and now let's open up for questions.
Thank you. So if you'd like to ask a question by phone, please signal by pressing star 1 on your telephone keypad. If you are using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. Again, press star 1 to ask a question. We'll pause just for a moment to allow everyone an opportunity to signal for questions. We will now take our first question from Casey Haire from Jefferies. Please go ahead.
Thanks. Good morning, guys.
Morning, Casey.
Wanted to start on the buyback. The guide says for a minimum of 1.6 million shares. I know that's the same amount of your authorization. I think there's a little bit of confusion that in the market that the buyback is poised to slow. Just would like to get your thoughts as to the total capital return ratio in 2020 versus that 105 level in 2019.
Yeah, so the 1.6 is what we have remaining, and we're going to see that through as we have talked about in the past. We are currently working on increasing that buyback authority, and so without providing specific numbers as to exactly what we're going to do from that perspective, you should assume that we're going to have an increase in our buyback authority similar to what we have done in 2018 and 19. And as long as we continue to generate and see continued progression of internal capital generation and the growth that we've outlined in the presentation, then you can safely assume that we will continue to be quite active on the buyback front. Now, when you think about the numbers from this year of us buying back 19 million shares, over the course of 19, we will see if that is the same. It'll depend on how things progress over the course of the year, balance sheet growth, pipelines build, potential opportunities that show up for portfolio acquisitions if they do down the road. So, there'll be some flexibility there, but we will continue being quite active on the buyback going forward. So there's, we don't have a 19 million like we did this year is unlikely to, we're unlikely to repeat that because we see better growth opportunities this year than what we had in the past. One of the reasons as to why we bought so many shares this year is that, remember, we sold close to, $1.6 billion of, residential mortgages, which did create some, excess capital capacity that we had. But we'll continue being very active in it, and you should assume that on average we'll be, actively buying back somewhere between 2.5 to 3 million bucks, 3 million shares every quarter.
Great. Thank you. All right, so switching to NIM. First off, just to clarify, so you guys, your 315 to 325 NIM does assume a Fed cut. What would that forecast look like if we did not get a Fed cut?
We're pretty we're pretty neutral from the perspective of the Fed cut. So again, if it's just one or none, I think that you'd have slightly higher, projections. So we'd be at the midpoint to the higher end of the range with no rate cuts sooner. We feel very good about getting there in a relatively benign environment where you don't have, much of a shift in either direction. But no doubt what you would see happen if we do have one rate cut is similar to what happened this year. We have $7.5 billion of assets that will reprice immediately, and then the funding stack and the deposit side will catch over some period of time. So we don't see a meaningfully different outlook from the perspective of the range, but the ability to get to the midpoint to the higher end of that range, I think, is easier within a no cut environment.
Okay, great. And just digging in a little deeper on the NIM outlook, the originated yields in the fourth quarter were 4.28. It looks like that's about 20 bips below your core loan yield. Do you expect, what's the new money yield today that's layered into your NIM forecast?
Yeah, so it's 425 to 450. There's always some volatility in that number based on whichever business line has a better quarter relative to another. So we feel pretty good that over the course of, and we're confident that in 2020, the new origination yield on average over the course of the year will be right at, we'll be in line with the runoff of existing loan yields.
Okay,
so we don't
great.
see, again, assuming the rate environment that we're talking about, right? So one cut to no cuts, right? So, there's, that we are very confident in that the pipelines are building at around those levels.
Okay, so around this it'll vary, but around this 430 level.
On average, correct. On average, it'll be right around that.
Okay, great. And just last one, just switching on the funding side, which appears to be a lot of like slide 10, I think you guys outline a number of drivers that are going to help you guys achieve that NIM stability this year. There's a number of them, obviously, deposit beta accelerating, online, consumer CDs and borrowings. Is it possible for you guys to try to, which are the big components are going to provide the most relief to funding costs in 2020, because just given all the moving parts?
I think all of those components, Casey.
Yeah.
Yeah, I think we've guided to this for the last couple of quarters. We are in the early stages of kind of funding stack repricing. So, especially on the deposit side. From a wholesale borrowings perspective, I think that there's, as we outlined there, the big step down did happen in the third and fourth quarter of this year. So you should see, that component of the funding stack will continue to result in roughly somewhere, approximately 5 basis points of repricing kind of quarter over quarter. But on the deposit side, it's across the board. CDs have started to reprice already in January. We've been guiding to that, in the last quarter call, saying that we had, when you look at the progression of CD costs over the course, especially on the commercial and consumer and commercial side, you'll see on that slide that none of it has really repriced at this point. So if you were to, I don't know if there's what's the lowest hanging fruit. We think that is probably the lowest hanging fruit because that is, those are, again, certain as to how those will, there's more certainty as how those are going to reprice. But, the broader opportunity here is across the board on consumer and commercial as well. We're still in the early stages of, as we said, these are full relationships. We are going to protect those relationships. So we've been very mindful of not upsetting the apple cart and kind of managing deposit rates the right way. But we're still in the very early stages of that. The deposit beta, which on the way up was approximately 35 to 40%, as we talked about many times, on that consumer and commercial side has only been 10%. So there's plenty of room there. And we will, again, we're going to manage it smartly. We are very focused on retaining those relationships, but at the same time, we're confident that there's room for substantial decreases as we continue to progress through 2020.
Yeah,
Great, thank you.
The two areas that really are very succinct on this thing is the CD side of this thing. We have $1.2 billion coming due that will significantly reprice, that are in the kind of 9 to 12-month CD range. And then the muni deposits that, as rates have come down, we've worked to retain the relationship muni balances, and we work to reprice the transaction-oriented municipal balances.
We will now take our next question from Steve Moss from B. Riley FBR. Please go ahead.
Good morning, guys.
Morning.
Just following up on the margin here, just as we think about the first quarter margin, it seems like off the core margin here, you were 313, but the 4 basis point impact from liquidity. And then I think, Jack, you said 5 to 10 basis point linked quarter decline in funding costs. So probably it sounds like probably a 320-ish core margin to start the quarter. Is that fair?
So I'd say that it's, so one thing that you have to factor in is that we do have the subordinated debt issuance is going to cost us a little bit in the first quarter. So we're actively working on right now and, evaluating various alternatives to take out the senior notes sooner than maturity. So the first quarter is going, it's not going to be at 320. It will be at the lower end of the range. But then as you essentially right-size the funding stack, you eliminate that 3.5% costing senior notes, and you continue to reprice the funding stack down. Given the fact that, we do anticipate and we have seen in the second half of the fourth quarter, asset yields, kind of abating from the perspective of not decreasing anymore, we feel pretty confident that we start the year at the lower end of that range and then we build up to it over the course of the year.
Okay, that's helpful, Luis. And then on loan growth here, just wondering, talk about organic loan growth in the deck, but organic loan growth this quarter is pretty flattish to down a little bit. I'm just wondering what are the dynamics you saw this quarter and why we didn't see a little more loan growth here.
Yeah, good question. So I think we guided last quarter to about $1.2 billion of commercial loan growth, and we realized about $800 million. There are a couple factors that affected that. One, we don't include, there's about $100 million worth of lease assets that we include in the other asset category. We sold off about $150 million worth of non-relationship loans in the quarter. Mortgage warehouse was down about $125 million because of the turn. People bought mortgages out of the warehouse faster. And then the balance was just some additional pay downs. So we actually had a good quarter from organic loan growth basis in between $400 and $500 million off of well over $1 billion of originations. So that's why, there's because of some of these items being a little bit extraordinary, it looks like there wasn't organic loan growth, but there was fairly meaningful organic loan growth.
Okay, that's helpful. And then just as we think about, acquisitions going forward, what's the appetite for portfolio purchases versus bank M&A here?
We've gone through this. Our history dictates we always are looking for portfolio acquisitions to change the asset mix and enhance the risk-adjusted returns on the revenue side. We acquire banks to find alternative funding sources. So, we are constantly looking for opportunities to, I went through it in my comments, to reinvent the company, and we will continue to do that. We think, in some cases prices make sense, in some cases prices don't make sense. In many cases, the asset quality doesn't make sense, and in some cases the asset quality does make sense in the portfolio acquisition. So we kind of constantly see opportunities to look at both portfolios and other banks and frankly other funding sources along the way.
All right. Thank you very much.
Thank you, Steve.
We will now take our next question from Alex Twerdahl from Piper Sandler. Please go ahead.
Good morning, guys.
Morning, Alex.
I just wanted to extend on that last question on acquisitions. Just as I look at the loan growth targets for 2020, it says the focus is on organic loan growth. So is the assumption that kind of the low end, at least of that, should be pretty much in hand organically, and should an acquisition come along, it kind of pushes you towards the top end of the range, or are acquisitions of loan portfolios just not contemplated at all in that guidance?
Now, your first comment is true. This is an organic number, the way we've presented this. So that would be the guidance on the net. Anything that we do over and above that will be over and above that guidance.
Okay, so that no acquisitions, and then similarly
right.
the expense number 420 to 430. That's as you see it today. That doesn't contemplate any sort of acquisitions as that number might have in the past.
That's correct.
Okay, great. And then just on the margin, you talk about the range of 315 to 325. Is that kind of a range for the full year margin, or are you saying that each quarter should be somewhere in that 315 to 325 range, implying that we're certainly going to see at least a little bit of margin expansion in the first quarter?
It's the latter, yes.
Yeah.
So it's essentially, that's the range of where we see the quarterly NIMs shaking out. So the full year NIM is unlikely to be at 325 because we're not going to start the year at that level. We anticipate that there's going to be a progression and expansion of that NIM, again with the big caveat regarding that we're assuming a relatively benign and stable rate environment, right? So that we always like to kind of throw out that disclaimer, but we are going to start. You're going to start at the lower end of the range, and then as we continue to maintain asset yields and reprice the funding stack. We should start seeing some nice NIM expansion over the course of the year.
Great. So it sounds to me like you guys are calling the bottom on the NIM in the fourth quarter, based on what you just said.
Yes.
Yeah. So again, remember that we have to, so especially a little bit of the driver of the NIM of some volatility short term is going to be how successful we are in retiring some of that higher cost debt that we have out there with the senior notes. So. We did issue $275 million of sub debt at a 4% rate, so that obviously will have a short-term impact. But then when you factor in that we're going to essentially take out those senior notes, I think that you essentially get to a net neutral position from the perspective of the debt. That's kind of the longer term, longer duration debt that's on the books. But yes, we feel very good and quite confident based on what we've seen in the second half of the fourth quarter that again asset yields have started to kind of they've leveled out, they've settled down, and then we continue to see very nice progression of repricing of the funding stack. So you're right, we're not at the bottom, we're pretty darn close.
Perfect. That's extremely helpful. And then just finally to clear up any confusion out there, the purchase accounting accretion guidance of 30 to 35 million. That's kind of right around where you've been targeting in the past for 2020. And can you give us any sort of color on where that might go in 2021? Is that going to basically trend towards zero for next year?
No, so in 2021 you're still going to have another 15 to 20 million or so. So you continue to see step downs every year, but the tail of the accretion income is pretty long. So you're going to see another step down of, call it 10 to 15, 10 to 12 million on the accretion income side, but there's still going to be some accretion flowing through in 2021.
Perfect. Thanks for taking my questions.
Thank you.
We will now take our next question from Dave Bishop from D.A. Davidson. Please go ahead.
Hey, good morning, gentlemen.
Good morning.
Hey, appreciate the disclosure in terms of deposit breakdown. Just curious, the online bank initiative, how big of a piece of the puzzle from a funding source do you think that grows to, and how should we think about that from an all-in cost? I guess some of that's flowing through the marketing cost this quarter. Any way to sort of benchmark what the all-in cost from that perspective is?
Sure. So we're spending approximately 25 basis points on I'll call it incremental to the interest rate on building out the online channel. Now, I caveat that by saying that it's I don't want to say it's not a misleading number, because it is right. It's just the fact that there are obviously shared services that the online bank also uses from the perspective of other infrastructure that we have built, right? So, but when you think about the direct expenses that are associated with originating that, kind of originating deposits through that channel, it's interest rate plus approximately 25 basis points. That's what it was in the second half of 2019. So, again, from an interest rate perspective, we realize and are cognizant of the fact that deposits are going to be higher cost and that they're going to be more rate sensitive, but in a low rate environment or generally benign rate environment, we feel very good that it is a very efficient way to generate funding, and it is a very efficient way to generate funding that allows us to continue to manage our efficiency ratio from the levels where it is today and potentially decreasing it further from there. So we very much like the funding channel, and we've talked about this for some time, that this was going to be a test and learn function, and so far the test and learn has worked out very much in line to exceeding the expectations that we had originally thought. So you'll see in that page that one of the key messages that we wanted to convey is the fact that there was pretty darn good growth from a spot balance perspective between the end of the third quarter and the fourth quarter, and yet you still saw that we were able to move down that cost of deposits by approximately 35 basis points from where we started. So we like the direction that business is headed. From the perspective of how big it gets, time will tell, and it's going to again, it's a test and learn function, and we're going to continue to tweak and dial pricing up and down, just based on whatever we see the need to be. Roughly, we anticipate that by the end of 2020, it should represent somewhere between 5 to 7% of the funding stack. So should be somewhere between, if you think about $22 to $23 billion of deposits that we have, that should be somewhere between $1 billion to $1.25 billion or so of deposits is what we're seeing. And again, that's what we think today. We are going to dial that up and down based on how other deposit channels also grow. But so far, we very much like the types of relationships and accounts that are being driven through that channel, and we very much like the how the channel has responded from the perspective of the overall customer acquisition cost and the ability to kind of move that pricing and dial that pricing up and down kind of almost on an immediate basis depending on what the funding needs are. It's a very efficient channel.
Got it. Appreciate the color and maybe some commentary in terms of maybe the core relationship-driven commercial real estate market. Just maybe talk about the opportunities you should move into 2020 from a growth perspective.
Yeah, we continue to look at the options out there of a variety of commercial real estate projects. It's one of the great things about being around metropolitan New York is there are as many different variations of commercial real estate opportunities as anywhere in the country. So, it may be, a lot of people are obviously concerned around the rent-controlled multifamily projects. There are very many other types of projects that we can get the risk-adjusted returns out of from a real estate standpoint that are available to us in this market. So we think the path is very clear on opportunities on commercial real estate in this metropolitan area.
Got it.
If you found your question has been answered, you may remove yourself from the queue by pressing star 2. We will now take our next question from Colin Gilbert from KBW. Please go ahead.
Thanks. Good morning, guys.
Hey, Colin.
Just wanted to dig in a little bit to the multifamily portfolio. It looks like, if I'm looking at this correctly, you guys saw growth this quarter relative to third quarter, and it looks like the loan yields kind of hung in a little bit as well. So just wanting to understand sort of how you're thinking about that portfolio, what was driving or what's going to drive the growth, and then how the New York City rent stabilized portion has been trending.
Yeah, so, again, there are a lot of options on this. And what we've tended to do, unlike other situations, we've tended to only focus on relationship-oriented multifamily deals. And frankly, relationship-oriented multifamily deals that do multiple projects. So most of our multifamily clients that we originate from on a direct origination basis have many projects and do many different types of real estate investing. So we do not do the transaction part of it, the broker originated multifamily projects where the only thing you have is the transaction. So we have so it's in the big category of multifamily. There's a lot of them that are done through the brokers, but there are amount that are done on a direct basis with real estate developers and multifamily owners along the way. So, pricing has started to stabilize in that market, and they're enhanced by other projects and other types of business you have from the client. So that's why you've seen kind of the yields hang in there on that period of time. It also means that we're running off some of the lower yielding stuff and adding some of the higher yielding relationship-oriented multifamily deals.
Okay. And then do you have the balance of what, I understand that's good color, Jack, on the growth going forward, but what the balance currently is of the New York City multifamily, kind of that broker originated portion?
You mean of rent controlled or of the total broker originated multifamily?
No, rent controlled.
When you say yes, you mean which one?
Sorry. Okay. New York City rent controlled multifamily. What the outstanding balance is of that book?
It's about $750 million. That is subject to rent control.
Okay. And has that changed? Have those balances changed much in the last few quarters?
Some of them have paid off. So yes, we've seen runoff in that book of approximately 100 to 150 million over the second half of third and fourth quarters. So far, we have not seen any major changes in performance in the book of business or any changes in trends in delinquencies. So, we don't have a lot of it. We are closely monitoring it, and we anticipate that over, some period of time, a lot of those loans begin, coming up for refinance and kind of renewals in the second half of 2020 and into 2021. And, we're going to actively work on figuring out what's the, kind of best course of action for that portfolio going forward. But right now, we can't point to anything that we would say is a cause for concern.
Yeah, these loans, too, tend to be older portfolio loans, and they tend to be less than 50% loan to value. So, that's why, we're not as concerned because of the rent-controlled aspect with the portfolio we have today because of the general loan to value, and they're more matured loans, so the repayments and the debt service coverages are very strong.
The vast majority of that portfolio, if not all of it, I think probably all of it does, but the vast majority of it comes from the acquisition of Astoria, and dating all the way back to when we acquired, Hudson Valley. So, from an LTV and an underwriting perspective, we are not concerned about that portfolio.
Okay. Okay. That's helpful. Thank you for that. And then just shifting to, OpEx and efficiency and Jack, again, you guys are, performance-oriented and operating leverage and all of that. But if we just look, so your OpEx, you've held at this 420, kind of if we think about core OpEx, since 2018. And is there going to be a point where that has to change, or there's going to be investment that's going to come down the pike? Just trying to sort of, it's an impressive hold, and I just wonder how long that can last.
Yeah, I think, our view is it can last for whatever. So the 40% is what we believe is the right level for that. And we make investments. We are constantly making investments in people and technology along the way, but we're balancing that by taking costs out of other areas. So we're constantly changing that mix. So our view is that will continue to change. Or continue to be consistent at the 40%. Remember, too, it's a numerator-denominator issue. So the numerator is revenue, and the denominator is expense. So it's just not an expense issue. It's also the generation of revenue and creating that operating leverage along the way. So I've said this a couple of times, and some people take this the right way, and some the wrong. But we actually have less people that produce higher revenue per FTE and earnings per FTE than peers, significantly higher, that frankly get paid more money. So we believe in that model, and it creates the type of efficiencies that we want. There are two big reasons why we are more efficient. One, we're not in inefficient businesses like mortgage, or like asset management, or like a big branch system. So that's one reason we're efficient. The second is the dynamic that I just mentioned. We have lower numbers of people that produce higher revenue and earnings per FTE than peers, and that frankly get paid more. So that dynamic kind of works to keep the efficiency ratio, about where it is today. I don't think that it can get into the 35% or below range. So if that's another just a follow on, I think there is a limit to how efficient you can be in financial services, but I think it is in that kind of 35 to 40% range, with targeted 40% as an ongoing target on this thing.
Okay, that's helpful. And then just one last housekeeping item for you, Luis. On the accretion guide of that $30 to $35 million, significantly less than what you guys posted, obviously, this year. Just thinking about that trajectory there of how you see that going, and just is there an opportunity? I mean, if pay down's slow, then I'm stating the obvious, I guess, that accretion number could end up being higher. Just trying to sort of reconcile the patterns there, because I think that came in higher than what you were originally anticipating for 2019 as well.
Yeah, so the pay downs, so the reason for it being, higher than what we thought in 19 was the fact that, yes, a lot of the remaining mark on the Astoria book was driven by the residential mortgage book. And so, the mortgage payoffs accelerated, pretty substantially over the course of the year. So we've been running at, call it $250 to $300 million a year in 18, and then in 19 we had close to $650 million of runoff, right? So, that certainly, was one of the, key drivers as to why that, why that was, higher than what we thought. And there's always a little bit of a risk from that perspective that you're going to have on providing accretion income guide, which is, it's going to be based on the overall performance of the book over some period of time. What remains today is not so much on the residential mortgage side, but actually more so on the multifamily side. And on that portfolio, we have, without having a magic crystal ball, we do have a little bit more visibility because it is rate sensitive too, obviously from the perspective of repayments and so forth, but it is not as efficient a marketplace as residential mortgages. The minute that you start seeing 5, 7, and 10-1 origination yields on the residential mortgage side that drop below 25 basis points of where they were, you start seeing a substantial pickup in in payoffs and increases. The multifamily side and the CRE side of the house does not behave as efficiently as residential mortgage. So we feel we feel very good, very confident about the 30 to 35 million. And don't think about it from the perspective of it being level over the course of the year, because remember, these are, it never happens level. There's always a higher tail. The tail gets lower as you go, every year. So you'll see that similar to what's happened in the last couple of years, where we started with about $28 million of accretion income per quarter, and then that moves to 25, moves to 20. Third quarter was about 17 million. This quarter was 19 million because we had some big payoffs and some specific, transactions. But you start seeing, it's going to follow the same type of pattern, which is it's going to be higher at the beginning of the year, and then it's going to fall off over the course of 2020, and then into 2021 it will follow the same type of pattern as well. But we feel, 35 million is a pretty good number. But we feel pretty confident that based on the mix of business that remains, that has a mark on it, it should, we should be pretty close to that number.
Okay, that's great. I will leave it there. Thanks, guys.
Thank you.
We will now take our next question from Steven Duong from RBC Capital Markets.
Hey, good morning, guys.
Good morning.
Morning. Just on the just going back to expenses, in the quarter, other expense line, that was a little high. That was I think it was higher marketing and retirement plans. Is that correct?
That is correct. So out of the increase of about $3 million, about half of that was driven by marketing, and about 30 or 40% of that other half of the $1.5 million was net cost on pension and retirement benefits.
Okay, great. And how much of that do you expect to gravitate down, maybe to 17 million level, or at all, if possible?
Yeah, that's you're going to see a run rate that's going to be much closer to what third quarter was versus Q4. So those are, the advertising is always going to, marketing will always be a little bit of a volatile line item, depending on what we do from either a promotional perspective or whatever to the discussion that we were having before regarding.
Got it. And so if yeah,
go ahead.
I guess so. If that goes down a little bit, then do you think that you could possibly get your 2020 expense to below a 420 line?
I think that anything is possible. Is it probable? No. I think that we have a pretty good handle on the investments that we want to make from the perspective of hiring the commercial banking teams and business development officers, and we're building out a lot on the especially on the deposit gathering channels on the commercial side with property management and legal services and the innovation finance team that we hired. So we feel pretty good that our we've held that expense line item relatively flat for the past 3 years if you factor in everything that we were able to store you. And right now the dynamic that you're going to see going forward is that now that we get to about 80 financial centers that we're going to be at by the end of 3/31, you're not going to see the same rate and pace of financial center consolidations that you have seen in the past, which is one of the things that has resulted in us allowing to kind of reduce and maintain that OpEx relatively flat. We are much more concerned this year with, again, maintaining that roughly 420, kind of low end, but also kind of getting back to, really meaningfully growing the top line revenue side of the house. And again, that does require investment. And, we see the need to, and we want to continue to invest, particularly on the deposit gathering side. So we will be actively looking to hire folks, and get back to, to getting, kind of more, robust and broader distribution channels on the deposit side again. So is it going to be below 420? Unlikely, but we feel very good about that range, and we feel good about the, kind of the midpoint to lower end of that range.
Great. And then just moving on to your loan portfolio, if we were just looking at the equipment finance portfolio ex Santander, can you just give us some color of what was going on in the quarter in that portfolio?
In which one? In equipment in particular?
Equipment, yeah. Yep.
It's been flat. It's been relatively flat. The the new origination yields that we are seeing in that market for the type of business that we originate, which are kind of higher credit, good and higher credit quality middle market commercial borrowers, has gotten extremely tight. So you're not going to see organic growth in equipment finance. We see better risk-adjusted returns and better credit spreads in other components of the portfolio, mainly, diversified CRE, all of the, projects that we're doing on the affordable housing side, as well as, public sector and some of the other more diverse, commercial lines. So, equipment is, it's over $2 billion today. The portfolio that we acquired from Santander is exactly what we thought it was, and in many respects, it's actually, a little bit better, just given that we've had, some nice fundings, and we inherited some, funding commitments from Santander there as well, which, has actually worked out very well because we've actually been able to grow those relationships slightly over the course of the quarter since we closed it. But, we are not, the focal point is not on growing equipment finance going forward because credit spreads are not really where we want them to be right now.
Got it. And is that similarly the same story on your ABL side?
Absolutely, 100%. We think that is, that's a market, that's a sector of the market that, you're not going to see growing organically because there's a broad universe of competitors, not just banks, but, more so, credit funds and alternative asset managers and insurance companies that have jumped into the ABL game, and from a spread perspective and a pricing perspective, we don't like what we're seeing there. But more so than on the pricing side, we're starting to see some, we've seen creeping into that business a combination of some enterprise value lending that a lot of market participants are adding onto, kind of what traditional ABL is that we really don't like. So you're not going to see that business grow organically.
Got it. And then just moving on to your warehouse line, how much in commitments do you have today relative to where you were a year ago?
So the portfolio has grown about 25% year over year from a commitments perspective. Facilities, the percentage of facility usage has always been approximately 55 to 65%. Always hovers in that range. You never want to be a warehouse lender where you're the loan lending relationship or where your relationship is being used to its fullest extent. They might be able to use it, and you have the capability to use it for a short period of time to a high utilization rate. But in the warehouse lending business, you really want to focus on clients that have diversified sources and that are managing, that utilization rate to somewhere, call it on average about 60%. But year over year, commitments in the book are, the amount of committed facilities has increased about 25%.
Yeah, are you guys still seeing that continue, somewhat continuing in 2020?
Yeah, one of the good things about being, a slightly bigger bank than what we were before is that you can obviously go and, provide financing to, larger, independent originators as well. So, that's a book that we realize and are cognizant of the fact that it has some volatility quarter over quarter, which I know is not, not the most favorite thing that folks like to see. And so therefore, we get it is a mortgage business after all, so there is some volatility to it. But we have a very consistent track record over the last 5 years of growing that business very steadily. When we inherited that business in the Sterling merger in 2000 in late 13, that business had about $200 million in outstandings. This quarter we had just under $1.3 billion in average outstandings. That business has grown very nicely, and it's going to continue to do so because the larger balance sheet size allows us to provide financing to sort of larger independent originators, which is, again, it's very scalable and very efficient. The growth in that book has been essentially on top of the same infrastructure that we inherited about 5 or 6 years ago. We like it a lot, but it's never going to be a disproportionate size of our business because we understand that the volatility aspect of it is not, it's not an investor fan favorite. We get that.
Yep, understood. And just one last one for me. Your securities book, you're looking to get it down to 15% the end of the year on earning assets. What can we expect as far as quarterly, runoff in the book?
So it's more so we want to get there from the perspective of growing the rest of the balance sheet more so than running off any particular component of it. However, with that said, we continue to see the trend that we have been seeing for the past 2 quarters, given the rate environment that we've had. The book, particularly the MBS book, because the municipal securities book of about $2.5 billion really does not cash flow much on a monthly basis, which we like a lot because we're sitting on a substantial amount of unrealized gains there. But the MBS book cash flows at somewhere between $75 to $100 million per quarter. So, If we did absolutely nothing and we did not reinvest a single security in the course of the year, you'd have approximately somewhere between $300 to $400 million of runoff in the book. That's not the intention. The intention is to get to that target level by growing the rest of the balance sheet and just maintaining the securities flat. So we will be reinvesting, but if we did nothing, you'd have about a $400 million runoff.
Got it. I appreciate the color, guys.
Thank you.
We will now take our next question from Matthew Rees from Stephens Incorporation. Please go ahead.
Hey, good morning.
Morning, Matt.
Jack, just focused on your comment in regards to late-stage credit. Couple of related questions. So the first is, as we wind back the tape and we look at all the portfolio deals you've ever done, I was hoping for a little bit of a review here. So where do balances stand in totality for the portfolio purchases? Where do balances stand today versus when you purchased them? How have they performed from a credit perspective versus your initial expectations? And if there were marks along the way on these books, could you give us some idea of what the average mark was, just for credit comfort?
It's a long list, man.
That's a really long list, Matt. I'm not sure we can go through each portfolio we've acquired. There's been 8 portfolio acquisitions over the period of time, but I would tell you that for the most part, what we have tried to do I'll start from a macro standpoint. What we have tried to do is create a diversified mix of portfolios in the company. And there are, at different types and times, they're going to be more or less favorable relative to the risk-adjusted returns and, frankly, the growth rates in those portfolios. So, we just had this conversation about equipment and ABL. One of the reasons we looked at the Santander portfolio, we essentially bought a year's worth of production at a really good yield, at really good quality, compared to what we would be able to appreciate through the year given the market dynamics of equipment. So we were very opportunistic with the portfolio. By buying it there, we basically bought the whole year's worth of volume that we would have expected on the equipment side. Luis mentioned ABL. The yield, the returns on ABL and the credit quality on the structure of the deals, the things people are doing in the market, mostly non-banks, have really diminished over the last several years. So we've tried to, as we purchase portfolios, we've tried to look at which portfolios we have an opportunity to continue to diversify with the right risk-adjusted returns out there. Some of them we buy and we frankly run down because it was a one-time buy. Most of them we use as a platform to grow from and to expand. We believe, again, the most current example, the Santander portfolio, we believe that the relationships that were incumbent in that portfolio allow us to go back to those clients and expand the relationship both on the equipment side and other banking services. So each portfolio has a different dynamic and a different need going forward. But at the end of the day, we're trying to take this mix, both organic, acquired by banks and acquired portfolio, to create the right risk-adjusted return out there.
To give you some big picture stats, on average, the credit marks that we've taken on these so the interest rate marks on each portfolio have been different just based on whatever the interest rate environment was at the time. So, the interest rates are, from an interest rate perspective, marks have been, kind of all over the place. From a credit perspective, on average, it's been about 2.5% for all the portfolios that we have acquired. Each one of those portfolios, the existing book of business when we acquired it, has performed very much in line or better than what we had originally thought. And so one of the reasons for, in 2019, for us having a higher, accretion income level that we had originally anticipated is the fact that as some of these assets roll off, if they performed better than what you thought they were going, particularly the purchase credit impaired loans, if they performed better than what you had originally marked them at, then that always results in some volatility in the accretion income side, because if something pays off or you had a mark on it and you didn't lose that amount of money, then you're actually going to get to accrete that back in the income, right? So that's one of the reasons as to why it has outperformed, is the fact that that accretion income has been higher than what we had originally thought is the fact that a lot of the portfolios that we have acquired have actually performed in line or better than expectations. The one portfolio that has not moved in our favor was the Advantage Transportation Finance transaction that we did in March of 2018. The existing portfolio performed very much in line and slightly better than what we had originally anticipated. But when we go back to the earnings calls and we announced that transaction, we had always guided to the fact that we were going to essentially tweak the origination engine that we inherited from Advantage. And we're going to move it a little bit further upstream because there was a component of credits that that Advantage focused on that we did not like from a credit quality perspective. And what we have found over the course of the last 2 years, in line with what we were talking about on the equipment side, is the fact that credit spreads in that industry to us don't make sense. And so today, if you were to ask, where does that portfolio stand? That portfolio is actually about $110 million lower than we acquired it. So it was $457 million when we acquired it. Today, we're at just over $300 million or so in remaining outstanding balances. That portfolio, by design, we have essentially kind of stepped off the throttle because we don't like what we see from the perspective of credit spreads and risk-adjusted returns in the business. Other than that, the other business lines that we have and the other portfolios that we have acquired, I think that the financial performance kind of speaks for itself. You have not seen, big hiccups from a credit perspective. You've seen, kind of pretty steady progression of what we've guided to from the perspective of what those portfolios are going to result in from an income and an expense perspective. So, as we've talked about in the past, the benefit of acquiring a portfolio in today's M&A world is the fact that, again, going back to the Santander example, we've had 9 months that we were working on that transaction. We had the opportunity to select assets that we wanted. We had the opportunity to essentially re-underwrite and review every asset that we acquired. We feel very comfortable, and that's what we've talked about in the past. To us, these portfolio acquisitions, realizing that they are not organic originations, from a risk perspective to us, they are, because they go through the exact same level of vetting and of due diligence that we would do for any organic origination, and we get the benefit of essentially marking it up front. So that's why we like it. I know that some folks consider an organic origination better than an acquisition. We can debate that as much as everybody wants. We very much like the aspect and the ability of us being able to re-underwrite the entirety of a portfolio and marking it up front. We feel that that's a good way to continue to grow the business and to allocate capital and liquidity.
And the other add I'd make on this is it does depend upon what price you pay.
Yeah.
So the dynamics on this are you mark you want to make sure that the credit quality is exactly what you want it to be. You want to make sure that your ongoing business is what you think it's going to be, but then you get to the point where you're buying it at a certain price and you're marking it at a certain price. So the net result of the answer to the initial question is every one of the portfolios has worked out from a return standpoint. We got there maybe in different ways than we designed it, but each of them have met or exceeded the targeted return. In some cases because it's performed better credit quality-wise. In some cases it's because we bought it at a discount or a price that made sense through a different cycle. So, we're very comfortable with these things. And again, it's all about there's multiple factors that go into this thing.
Right. No, that's extremely helpful. And then maybe just tying this into what we saw from a special mention and substandard loan progression standpoint, were any of those the increase, from acquired books, or what categories were they in? Your workout expectations, and what time frame do you think we should see those resolve?
Yeah, so the increase was driven by commercial real estate credits and a couple of ABL credits. One of the ABL credits was an acquired credit. We feel very good about the, different to the other three credits that we had talked about from an ABL perspective in 19, that we have now fully gotten behind us, as Jack alluded to in his comments. And, so they are off our books and fully exited. In every one of those situations, the assets are in the loan relationships are performing and they are very well secured. So, we have a combination of good collateral. We have a combination of good marks on each one of these, and we feel good about being able to work out of these in a relatively short time frame. So in the next quarter or two, we feel pretty confident that we're going to be able to exit these relationships or work out of them in a way that makes sense, and it should not have a big impact from a credit quality perspective or a charge-off perspective.
Okay. Can you talk a little bit about the Deloitte and Innovation Finance Group? Two recent announcements. I don't think I have a good handle on what these are poised to do near term, long term. Could you just help me kind of understand what the impacts might be over the next year or 2 years from these two, the partnership and the Innovation Finance Group?
Yeah, so the Deloitte side of this thing, we've been working with Deloitte for now probably 18 months or so. They have done a number of things for us, not the least of which was they provide us with the tools on the artificial intelligence side. As we've used AI, we've used their kind of machines to put in place in a variety of different areas. But the Deloitte side of it is multiple areas. So one, a simple thing, Deloitte over the years have built up a very, very large technology support mechanism. We started a process with them where we do simple things like all the laptops and all the fulfillment of devices in the company now is fulfilled by them rather than, frankly, the fragmented way we were doing it before. They provide us with the IT help desk. Again, the metrics on their performance on IT help desk versus what we were using before are dramatically different. Third is they look at helping us put everything into the cloud. So we're using their mechanisms to go into the cloud. And then continued on that, we're using them to do projects like the voice-activated, internally voice-activated, kind of artificial intelligence that provides internal support and external support to things like call centers. So there are many, many different pieces where we're using them, and frankly, we're already experiencing performance levels that are significantly more than what we were doing ourselves or we were outsourcing to other people, and essentially at the same cost. If you bake in all the costs, because the other question will come up, is this a lot more expensive? The answer in total is no. We are basically moving costs from one area to another, and the performance is much higher. So unlike the big banks that can go out and they're spending capital where they're building all these things themselves, this is our answer to, or partially an answer to, how we can be very contemporary in terms of providing the right levels of technology spends and actuation of our technology dollars. So that's how the partnership works. And again, the final part of this, they'll continue to provide the bots on our AI processes as we work to take all manual processes out of the company and automate them or outsource them going forward. It's a little bit of an answer to Colin's question about efficiency too. We're using technology to ultimately drive down the costs and create better efficiencies along the way. The technology team that we have is a team that is focused on a very specific niche, and it's actually lending and deposit gathering to companies that have kind of residual types of earning streams. So this is not venture lending, and it's not spec lending. It is lending against software companies that have a variety of cash flows coming in from the contracts they have. So it's a successful group that has worked for a couple different very highly recognized businesses on the technology side, and they're already off to a really good start, both on, again, the lending side and also the deposit gathering side.
Just a follow-up there, could you give us a sense for the team you hired, the size of their book from their prior institution, both on the loan and deposit side that they're looking to recapture?
To be honest, I don't know. It's this is a 3-person team, by the way. It's not 30 or 40 people.
Understood. Okay. Last one is just on the extent we might see share repurchases. Luis, we used to talk in regards to share repurchases, perhaps in terms of capital goals in regards to tangible common equity to tangible assets. Is the long-term goal still to get to around 8 to 8.25%? And should we think about share repurchases as a tool to help you get there, as essentially a plug, perhaps?
The answer is yes to all of the above. But listen, we generate a lot of capital, and one of the reasons for us kind of moving a little bit away from that, providing that type of guidance, is that similar to what happened in 2019. Where we had robust share repurchase activity, we generate sufficient capital that we didn't really chew into too much of that into that capital ratio. So we anticipate that the balance sheet starts growing again this year relative to 2019. Remember that we're not anticipating any major sales of assets like we had with the residential mortgages earlier in the year, which created a lot of excess capital on the balance sheet. So we think that the balance sheet gets back to growing, and that's the reason as to why we're being a little bit more, conservative on the, kind of the outlook for, buyback. So it's still going to be meaningful. We're still going to use it as a tool to get to that longer-term target, but that is a longer-term target. I don't see a scenario barring, some substantial, growth opportunity, either organic or, on the acquisition front. I do not envision that we would get to 8.25 by the end of this year. But
okay,
we will be pretty darn.
That's all I had. Thanks, guys.
Appreciate it. Thanks, Matt.
This is the end of our question and answer session. I would now like to turn the call over to our hosts.
Hey, thanks a lot for following us through the year. I actually really want to thank our colleagues and our clients and our shareholders, obviously, and investors. We hope you buy the stock. And, in all seriousness, we are turning our attention from kind of repositioning the balance sheet. You had a company that in an environment in 2018 where you had, Fed increases in rates, and then in 2019, just a reversal to the 3 decreases. And it's enabled us to reposition the balance sheet and turn our attention now into 2020 on kind of getting back to creating that positive operating leverage where we're growing revenues faster than expenses. So we appreciate you all following us, and if you have any questions, give us a call. Thanks a lot. Have a great day.
This concludes today's call. Thank you for your participation. You may now disconnect.